Okay, imagine this. Bitcoin, it's just hit this incredible high and then bam, it plunges. Not just the little dip, but a real shockwave that makes even experienced traders look twice. Today on the deep dive, we're not just going to glance at the headlines about that drop. We're aiming to, pull back the curtain a bit. We're using an excerpt from Bitcoin Correction and Market Outlook to really show you why something so valuable can shift so fast. And what that recent correction, well, what it actually signals for the whole market. Think of this as your fast track to getting what just happened.
Yeah, fast track is good because things move incredibly quickly in these digital asset markets. It's almost never just one single cause, is it? What's really interesting about this deep dive, I think, is how it shows that complex interplay. You've got investor psychology, you have huge institutional money moving, and then these broader economic signals kind of hanging over everything. It's a really complex ecosystem, way more complex than just looking at a price chart might make you think. We're going to try and untangle that for you.
Okay, let's dig into those first numbers, the ones that really grab your attention. Our source lays it out pretty clearly, a sharp correction for Bitcoin. It pulled back from that amazing record high, what was it, around $124,000, which
Yeah.
is just, a huge number itself for one asset. But the key part, it didn't just ease off, it dropped hard down to about $112,000. So that's roughly what, 10% drop, around $12,000 per coin, gone pretty quickly. When you're talking about an asset with Bitcoin's market cap, well, it's more than a wobble. It's a massive repricing.
Yeah.
What does a swing like that tell us? About its volatility, sure, but maybe about the feeling right at that peak.
Right. That kind of 10% correction right after hitting a new all-time high. It's actually a pretty classic market reaction in some ways. But the speed and the sheer scale for Bitcoin, that's what makes it stand out. Often when something shoots up that fast, you get this buildup of, let's call it euphoric pressure. It gets overextended. So a correction in that sense isn't automatically a bad sign. It can be quite natural, even healthy, like the market taking a breath after running uphill. But the speed, the velocity of this drop, yeah, that does suggest maybe some fragility right at that $124,000 point. Like people were ready to hit sell at the first sign of trouble.
A quick trigger finger, definitely. So what made them pull that trigger? The analysis we're looking at highlights two main drivers, and they often seem to feed off each other, don't they? First, the simple one, profit taking, makes sense. You hit a record, people want to lock in those gains. But the second one, maybe more strategic, was this rising caution before key U.S. Federal Reserve events. Profit taking feels almost automatic, but how do these two things really interact in the crypto space specifically? Is it different from other markets?
That's a really crucial point, the interaction. Profit taking is, well, it's just what it sounds like. Investors cashing out, especially if they bought way lower and are looking at huge paper gains. The amount of profit taking right after 124K suggests maybe a lot of people, perhaps newer folks in the market, had that sort of quick profit goal in mind. So you get this group starting to sell, de-risking quickly. And that then bumps right into the second factor, the caution about the Fed. When the Fed's about to talk, especially about interest rates or their broader monetary policy, it casts this shadow over everything. Traditional markets, crypto, everything. For instance, if rates might go up, suddenly safer things like government bonds look a bit better. So investors might think, maybe I'll move some money out of riskier stuff like Bitcoin. So you have profit takers starting the downward push, and then this macroeconomic uncertainty gives others a reason to pull back too. It's like a 1-2 punch. Explains a lot of that initial big drop.
A potent one-two punch, absolutely. And if that wasn't enough pressure, the source material talks about things that made it even worse, right? Really amplified the downturn. It mentions over $1 billion in liquidations and also significant outflows from Bitcoin spot ETFs. Mhm. For people maybe less familiar with the nitty-gritty of crypto trading, could you quickly explain how these leverage positions play into this, and then how these two things, liquidations and ETF outflows, turned a correction into something deeper?
Yeah, definitely. Let's break down leverage first. It's basically borrowing money to trade with. So you can control a much larger position than your actual capital would allow, hoping for bigger gains. But the flip side is much bigger potential losses. Now, a leveraged position means you've borrowed to make this bigger bet. If the price moves against your bet and hits a certain point, the exchange automatically closes your position. They force sell it to stop you, and them losing even more money. That forced sale is a liquidation. So the score says over $1 billion in liquidations. That's a massive sudden flood of sell orders hitting the market. It's not people choosing to sell based on strategy anymore. It's purely mechanical, a chain reaction. And that just pours fuel on the fire, accelerating the drop way beyond what simple profit taking would do.
turns a dip into a dive.
Okay, so the liquidations are like this forced selling cascade, adding huge downward pressure, and then you layer on top of that significant outflows from Bitcoin spot ETFs. These ETFs were supposed to be this big bridge for institutional money, right? A sign of stable demand. How do they suddenly become part of the problem, amplifying the downturn?
That's a critical point, and it tells us a lot about how the market's changing. These spot ETFs, they were designed precisely for that, to give traditional investors, like big institutions, wealth managers, even regular folks, through their brokered accounts, an easy, regulated way to get Bitcoin exposure. They didn't have to worry about wallets or keys, just buy the ETF. And yes, they were seen as a huge deal for bringing in steady long-term capital. So when you suddenly see significant outflows from these ETFs, it's a pretty clear signal. It means some of that mainstream, possibly institutional capital is heading for the exits, at least temporarily. It suggests that this group, which was a big part of the demand story, is maybe getting nervous, pulling back, waiting to see what happens with the Fed, with the price action. This effectively takes away a big chunk of buying support right when the price is already falling, adds more downward pressure. And it definitely raises that important question for you listening. What does this pullback from the ETF investors tell us about their short-term belief, their conviction, especially since they were seen as this bedrock of stable demand?
That is a fascinating question, and it sets up the next piece of this puzzle perfectly because the analysis we're drawing from offers this really interesting contrast. Despite all these pressures, the profit taking, the Fed worries, those $1 billion in liquidations, the ETF money flowing out the source also points out that analysts say institutional demand remains strong. How do those two things fit together? It sounds contradictory. And then it adds the usual caveat. Short-term downside pressures persist as markets await central bank guidance. So what's the real signal here through all the noise?
Yeah, this is where you really have to distinguish between the short-term noise and potentially longer-term signals. It's vital. While the immediate market action might be dominated by quick profit-taking and those forced liquidations from leveraged traders getting wiped out, the statement institutional demand remains strong points to something else entirely, something more fundamental. These are often your really big players. Think pension funds, maybe sovereign wealth funds, large asset managers. They tend to look at Bitcoin differently, not as just a quick trade. For them, it might be a strategic long-term holding, maybe a hedge against inflation, or a way to diversify their portfolios, or perhaps they just believe in the underlying tech long-term. They might actually see these dips, these corrections, as buying opportunities, a chance to add to their positions at a better price. So you have the noise, the short-term selling pressure driving the price down day to day. But the signal could be that this more patient, substantial pool of capital still believes in the long-term value. They kind of provide an underlying floor, maybe stopping the price from falling even further.
And that ties straight back into that persistent phrase, short-term downside pressures as markets await central bank guidance. It's not just filler. It really underlines how much these big macroeconomic factors influence everything now, including crypto. Think about it. If the Fed hints strongly that interest rates are going up more aggressively, borrowing gets more expensive. That tends to make investors less willing to take risks. So capital might shift away from things seen as speculative, like maybe Bitcoin in the short term, towards safer assets like bonds, which suddenly offer a better relative return. Or, flip side, maybe high inflation numbers come out. You might think that helps Bitcoin's digital gold story, right? But even then, the market's immediate reaction often depends more on how they expect the Fed to react to that inflation news. It gets complicated fast. So the point is, until the market gets more clarity on where things are headed with interest rates, inflation, overall economic growth, Bitcoin, even with its unique features, is still really exposed to these traditional financial headwinds. It shapes the whole risk environment.
Right. So putting all these pieces together, what does this actually mean for you, the person trying to make sense of this, trying to navigate this sometimes confusing market? How do we synthesize all this complex information to get a clear picture of where Bitcoin is right now?
Well, what this deep dive really shows us is that behind that single headline number, that big price drop, there was this whole complex chain of events. It started with Bitcoin maybe getting a bit ahead of itself, hitting a peak that triggered natural profit taking. But that initial pullback got violently accelerated by those leveraged liquidations that forced selling we talked about. At the same time, you had some of that newer ETF-based capital taking a step back, likely due to the broader economic uncertainty, especially around the Fed's next moves. So it wasn't just one thing, it was this convergence, this perfect storm almost of investor psychology, the specific mechanics of the crypto market like leverage, and these overarching macroeconomic pressures. The key takeaway for you, I think, is understanding that these corrections are rarely simple. They show just how interconnected Bitcoin has become with the traditional financial world.
It's definitely a complex picture, but hopefully you feel like you've just gotten a clearer view of how to dissect these moves. We went from that peak euphoria down into the sharp correction, and we unpacked the triggers, profit-taking, Fed caution, and then those amplifiers like liquidations and ETF flows. What seems to emerge is this picture of Bitcoin caught in a tug of war. On one side, you have this underlying belief from long-term, large-scale investors. On the other, these very real short-term headwinds from market structure and the global economy.
Exactly. And if you connect that to the even bigger picture, this whole episode really illustrates something fundamental. The crypto market, especially Bitcoin, isn't operating in its own little bubble anymore.
Yeah.
Not at all. It's deeply intertwined with traditional finance, with macroeconomic forces, with central bank decisions. Understanding how all these pieces fit together, well, it's not just interesting anymore. It's pretty much essential if you're trying to follow the financial world today.
That's a crucial point to end on, and it leaves us with a really important question for you to think about after we wrap up. With these traditional financial players getting more involved, with products like spot ETFs becoming mainstream, is Bitcoin's price going to become even more tied to global economic news? Will it start behaving just like any other risk asset, maybe losing some of that unique, uncorrelated appeal it used to have? Or will it manage to carve out a new kind of role within this much larger financial system? Something to ponder.